Hey guys, Bratt here, the real estate Jedi with Big Block Realty. I want to make a quick video about interest rates. I know I've done this a number of times, but I'm pretty sure a number of you have not watched the other videos, and I just want to make something very clear. As interest rates are going up, not anticipating to go up, they've already gone up recently, okay? So this isn't to scare you. This might even be out of reach right now for a lot of you. But I wanted to make a video just comparing how every incremental increase in interest rates affects not only your payment and your affordability, but also the rate at which you pay down your principal. And this is imperative because just as much as anything else means money in your pocket, such as a lower interest, a lower payment overall, more money in your pocket, a lower amount of your money going towards principal pay down also means less money in your pocket because you are taking longer to pay down the amount of money you owe. So if we have a lower interest rate, more of that money, even though you have a lower payment, a much higher amount of money is going towards paying off your money owed, meaning when you sell, you get more proceeds and more net proceeds. Whereas with a higher interest rate, even though you're paying a much higher rate, it's not all just going towards interest. Actually, most of it is just going towards interest. The amount paying down your balance is much lower. So let me just show you what I mean real quick. I have 4 different scenarios here. Bear with me, it's going to be a little bit longer of a video, but you should watch this if you want to know where your money's going. So many people are focusing on price. How about we focus on getting a good deal for you now before prices go up further, but also getting a good interest rate before interest rates go up to, just a happy norm of 5.25 or 6.25, which is much more realistically market average, considering the grand scheme of things, than where we're at right now at high 3s or low 4s. All right. So on all this, I'm just assuming it could be whatever balance you want. $500,000, $250,000, $1 million, okay? The same principles are going to apply. So at 3.25, this is, I quickly jotted this out. So this is going to be your percentage of remaining balance. So if we're at 100%, obviously that's going to be the start of the loan. Down here, we're considering a 30-year fixed rate fully amortized loan, meaning after 360 payments, which is 30 years, you will be at a balance of 0. So the same thing for all of these. The same exact scenario, the only difference is the interest rates. So let's just start here. This is your percentage balance. This is the interesting thing that you need to keep in mind. So if we start off at 3.25, let me look at my notes here. Your original payment, and this is also considering your payment. So each payment that goes on, 1 through 180 and 360 here. Most people aren't going to hold on to it for 360 payments. That said, you need to understand how it goes, okay? So in the beginning, this is what your curve looks like. So your curve, and I'll explain this in 1 second. So if your crossover right here is at payment 105, which is actually 8.75 years, at 8.75 years, your payments are starting to have the majority of it going towards paying down principal, and then the rest of it is going towards interest. So this is your interest payment. This is percentage of your payment going towards interest, while this is a percentage of your payment going towards paying down your principal. So your remaining balance curve will look something like this. And actually, it would start decelerating, well, it start accelerating and pay down much faster after this crisscross, because up until this point, the majority of your payment is going towards interest, paying the banks, and then less of it's going towards principal. After this payoff, after this crisscross at 105 payments, 8.75 years, that's when you really start to see the most dramatic payoff of principal. Now, let's consider a slightly higher rate. You might think this is, 8.75 years, okay, that's tolerable. Let's just see how it continues to go. So at 4.25% rate, again, 30-year fixed, your crossover, we're starting here. If you notice here, it's a 60-40 in the beginning. So 60% of your payments going towards interest, 40% is going towards principal in the very beginning. And obviously at the end, it's closer to 100% and 0% because all of your interest gets paid up front. That said, for 4.25, check this out. We're starting at 70% of your payment going towards interest. And you're going to see these curves are going to change a little bit more. You're starting off at 70% and then 30%. And don't mind this is not exactly to scale. But your crisscross is going to be a bit further out, and that's actually going to be a payment 165. And that's actually 13.75 years. So at almost 14 years, just one increase in interest payment, you are waiting almost 14 years before the crisscross happens. The majority of your payment is going towards paying down your balance. You think that's bad, that's actually great still, relatively speaking. Historically, even a 4.25 is a great rate. When I bought my first property, I had a 6%, and I thought it was fantastic. So just saying. Let's look at 5.25. And obviously these things are going to keep changing. You can tell the direction we're going, but I just want to make a point. So 5.25, we're starting at 80% of your payment is going towards interest. And then only 30% of it, okay, I really jacked this one up. This should actually be a much more round curve over here, more like this. Because let me just fix that. Because for the majority of time, your payment, for a much longer period of time, the majority of your payment is actually going towards interest for that much longer. And let's just look at the last one real quick. So at 85%, it's going to look more like this, and it's going to look more like this. So we're waiting here until payment 203, and that's 16.9 years. And you crisscross over here, let's just do 19 years, all right? It's at 19 years, so we go from 8.75 years, 13.75 years, 17 years, 19 years. All of this time, the majority of your interest, the amount of your payment going towards interest is changing drastically. So I want you to understand, if you are going to sell your property in the next 5 to 7 years after you buy it, which is actually the national average, everybody either sells or refinances typically every 5 to 7 years, what difference would it make if much more of your payment, 40%, which is actually a heck of a lot more than only 20%, is going towards paying down your balance from the get-go, from payment one? Because 5 years in, you're going to actually owe less because you've already paid down that much more, and you're going to profit that much more when you sell. So not only do you have lower payments, but much higher amount of that payment is going towards interest. And let me just kind of make one final point here. The interesting thing is too, just to kind of put a number on it. At the end of 30 years, were you to pay it off over a 30-year period, 57%. The ratio of the interest paid to the original balance is only 57% on a 3.25. On a 4.25, we are talking 77%. Look how much that escalated just with one percentage point increase. And then let's say 5.25. Get this. I'm sorry, I'm kind of going all over the place here. 98. All right, 98.9. So 99%. And over here, guess how much? 120%. 120% of the amount paid in the end, the cumulative amount paid, went towards interest. I mean, the total balance paid. So if you borrowed $500,000, or I'm sorry, if you borrowed $100,000, at the end of the 30 years, you would have paid $120,000 just on interest. If you had borrowed $100,000 here, only $57,000 fully amortized would have gone towards interest. And you might sound like that's a lot, but that's very important to keep in mind. Pay attention to what your interest rate is. Just to put things in perspective, again, all of these are relatively phenomenal rates. I actually, for one, happen to have a couple interest rates right now at 7.515. You can always make good deals, don't depend on interest rates. So don't get caught up in what the interest rate is, but I'll tell you what, don't get caught up in price when you're talking $5,000, $10,000, when you can be locking in a darn good rate right now versus them going up later, and you can be saving yourself a lot more than that $5,000 or $10,000 you're squabbling over. Pay attention to interest rates just as much as you do price, and also remember 4.25 and 5.25 are still good rates. Bratt here with the Real Estate Jedi. Talk to you in the next video.